And Hisham, we can start now. And Hisham, can you hear me?
أيوة.
Okay, we can start now.
Okay. Um, shall I speak in Arabic or English?
Uh, as you like.
طيب. Okay. طيب. Good evening, everyone. My name is Hisham Wahbi. It's a pleasure to be with you as part of this program. Today, I will be speaking to you about pitching to investors. Okay. So I'm going to be going through some general guidelines about what it's like to pitch to investors, etc. So this will be the first half of my talk, and the second part will be about how to pitch to an investor, like what is the art of pitching, so to speak. Okay. So I will start with talking about funding and the equity model. What is it? What is the landscape of investment or funding for startups looks like, and how it works generally? Okay, and I'll start this with a very simple example. Okay, so this is typically what a company would look like. At the beginning of its founding, you have a couple of founders, possibly yourself and another co-founder, and possibly you might have someone who is an expert in something in particular as another partner. And some of you may have put money into the company, and some of you have given. So, like for example, this technical director, we've given them some shares as part of their participation in supporting the company without putting in any money. Okay, so in some way you have distributed your shares along with your co-founders. Okay, and as you can see in this case, the company has started with a total funding of about 4,000. So this is in Egyptian pounds as an example. Okay, of 4,000 Egyptian pounds. The company valuation is still unknown. We don't know. There's nothing to prove what is the value of the company. But we've decided to split it up into 1,000 shares. Okay, and then after several rounds of investment, it looks something like this. Okay, so at this point, we've had possibly a rich relative, rich aunt, who has put in some money at the beginning and taken some shares. And then we have also gotten an angel investor, put in, say, 100,000. And then we have gotten a VC or venture capitalist who has put in, say, $1 million, or whatever the amount is. So you go through these series of funding, okay? At the end, it kind of looks like this. Even though you have received, you now have the same number of shares, but you have a smaller percentage of the ownership of the company overall, because you have now added more shares for all of these other investors who have diluted you, who have reduced your share. So instead of each founder having about 40%, as it was in the beginning, they now each have about 25%. But it's 25% of something bigger. So initially the funding was only £4,000, and now the total funding is about £1 million. And based on that, the company valuation is now about 5 million Egyptian pounds. Okay, with a total number of shares that is now bigger. So we started with 1,000 shares, but each time we have an investor, we give them new shares, which are added on top of the existing shares. And so the total number of shares is increasing along the way. And so if we divide the company valuation by the total number of shares, we get the share price of about £3,000. Okay, so this is just a very, very brief example to give you an idea of how investors think about the company, that they're investing to own shares or own what we call equity in the company. Okay, so there are different kinds of investors and different stages of investors, which we've talked about in this model. Okay, so basically you go through these kinds of investors in kind of a certain order. Okay, and each stage of investment is associated with a certain type of risk. Of course, as we know, startups, they have a lot of risk, but the risk, we can define it as a number of things. There is a technology risk, which is, in the beginning, we're still testing whether the technology actually works, or whether we'll be able to build the product that we're talking about. And then we're going to be talking about a market risk, whether this is a company that is a product that is needed in the market, or the market would be willing to accept. And then there is a growth risk, or whether are we able to grow this company and make it work and scale it and maintain our operations in a good way. And then eventually, then there's no risk. It becomes a proven model, and then there's also funding for that. And so again, as I said, for each of these stages, we start with friends, family, and fools. We call them the triple F. When we are still developing the concept of prototype, and this is when we are these are the kinds of people who are willing to invest in it when there's still no clear product. There's still a technology risk. And then the angel investors and incubators, accelerators come in when there's the stage of the market risk, moving from technology to business. You're going in with the product to the market. And then and finally the venture capitalists come in when it's a market ready product, but we're going into production, we're going into trying to scale. And so this is the VCs come in at this stage where there's only the growth risk is involved. And then if you have no risk, then it's better for you to go to the bank, okay, to go to some kind of lending model, because then you don't have to give away any equity. Okay, and then finally there's also funding through social funds. Don't forget about this. If you are doing something that has a social or innovation or impact aspects of your business, then there are lots of these non-profit organizations, social funds, development grants, NGOs, etc., who would be willing to give you funding to support the kind of thing that you are doing. Okay, so what is your role in all this? How do you approach this? Okay, and how do you approach these investors? Okay, what an investor wants to see. We'll think about it from the 2 points of view. Okay, so what's your point of view and what's the investor's point of view? Okay, so you have to ask yourself, why am I here as an entrepreneur? Okay, why am I going to an investor to ask for their money? Okay, so from the entrepreneur, typically you have something that you are passionate about and you are good at. Okay, so this is important to show to an investor that you have, you're really passionate and like what you're doing, and you are good at it. You are the right person to be executing this startup. You are working on something that you want to grow fast. It's not just a lifestyle business. This is important also for investors. They are investing for something that's going to move fast. Where a lot of people, start a company and they would like to run it, at their own pace, and this is great. This is fine. But then this is not the kind of company that you should be seeking investment for. Okay, so investment is typically, you have to show that there's a path to fast growth. Okay, and you need money to make it grow. Okay, so there's there's you've overcome some of the other obstacles, but now the main obstacle that you need is that you need money to grow this company. And also, it's very important that you understand that as an entrepreneur, you sometimes want someone who can support you with experience, with industry experience or other kinds of experience that will allow you to make the company successful. Okay, so this is your point of view. Now let's think about the investor. Okay, why is he or she here, the investor? Why would they look at companies? Why would they invest in your startup or any startup? So the investor, this is their point of view. I have some unused money to invest. I have some money that I would like to invest in this kind of this kind of thing. I want to increase my returns. Okay, so I have I'm looking for profit. I'm looking to make some money back from this return on investment, as we call it. So I want to see an opportunity that in the market that can make these returns, and the fast growth. I want to see the plan for how this company can grow fast. Also, what a lot of people usually overlook and are not aware of is I'm interested in the topic. I'm actually I'm not just investing because I want to make money. I'm really actually interested in what you're doing, and that's why I'm choosing, say 3 or 4 companies a year to invest in. And these specific companies, I believe, I'm interested in them. I want to add value. I want to make an impact by investing in these companies. Otherwise, it would be really much easier for me to go and invest through, say, the stock market, or through putting the money in the bank in some way, or so on. Okay. So investors who go to invest in startups or in entrepreneurs, they are actually think of themselves as entrepreneurs themselves. They're interested in the topic. They want to make an impact by making this investment. So you really need to understand this when you're talking to an investor, and you need to appeal to that aspect as well. Okay. Also, the last thing is the investor is busy. Okay, he wants to invest in several things. Okay, and so he cannot focus on doing this particular thing, even though he might be able to do it if he focuses on that one thing, but or maybe not. But he's really looking for the team. So this is the most important thing that the investor is looking for, is a strong team that I can trust and rely on. Okay, I can trust that they are going to be trustworthy and take good care of the investment, and I can rely on that they understand that they have the skills needed to execute this investment or this startup. Okay, so this is the overview, and so you really need to show the investor that you have a real promising business idea. And this is a summary of really what you're trying to show. You have a real existing and large market that you can sell the product to. The product has to be what we call a broken leg, like it's a real problem that you would need. So if you have a broken leg, you're going to go to the doctor. But if your leg is just hurting a little bit, you might just ignore it, right? So this is you want to show that your product is something that's solving a broken leg type of problem. It's targeting paying customers. There are customers who would be willing to pay for this product. And differentiation is very important. How are you different from others? Barriers to entry. How will you limit competitors? How will you stop others from entering the same market? Innovation. You have to show how it's innovative. How this is the only real way to create value. Because if you're not innovating, you're probably in a market where it has a very small margin for profit, and so there's no real potential for growth. Okay, and then de-risking. You have to show the investor that you have a plan to find and eliminate the assumptions. You have, of course, any business comes with risks and assumptions, but you want to show how you're de-risking the business, how you are planning to first find those things that are assumptions and try to eliminate them as early as possible. Okay. And one other thing before we move on is something very, very important to understand as well. Investors are looking for startups that will succeed with them or without them. Okay, at the end of the day, there is an interesting fact that only less than 2% of startups actually get funded, and so that means that even though we know that the success rate of startups is about 10 to 20%, but that still means that there are at least 8 to 18% of startups that succeed without funding. Okay, so so this is very important to understand that it's not don't consider that the lack of funding is the thing that's going to stop you. You have to move, and you have to show the investor that you're going to be moving with them or without them. But on the other hand, there's another statistic that says that 68% of startups fail due to a bad team. Okay, so if you don't have the right team, there's a big chance that your startup will fail. And so this is a very important thing that investors look for. You want to show them that you are the right team to execute this thing that you are proposing. Okay. So to summarize this part, how to approach investors. Okay, how do I approach an investor? What you need. Okay, so you need a few things. It's very simple. You need a solid business model and action plan. You need to have thought about the business model and what's your plan to develop the business, of course, obviously. You need a solid team that is hitting all the right things. So you've shown me, you're going to show the investor that you have a good opportunity, but you have to show them that you are the right team that can execute this. Of course, you have to put together a pitch deck, and we'll be talking about that in a moment, and then practice pitching that pitch deck. And then you need to also develop, some kind of written business plan eventually, okay? And think about it very simply. You can start with, a blurb, which is like just a few lines, 3 or 4 lines, and then a 1-pager, a 5-pager, a detailed document, etc. So you have different versions of your business plan or executive summary, etc., so that you can, when you're approaching investors, depending on the situation, each situation, you will need a certain size. So you don't send the first email to an investor and send them, the full 20, 30 page business plan. You send them just a short email with 3 lines about it, and perhaps you attach a 1-pager. And then if they ask for more information, then you can provide more information. You need to put together your financial projections, obviously. And you need to have a plan, okay? You need to know what are your objectives through the investment. How much money are you going to raise, and how you're going to raise them, okay? So here's, some very, simple, guidelines about how to put together this plan, or we call it the investor roadshow. You need to put together, an investor shortlist. So you put, list the investors that you want to approach. Okay, research those investors before you go to meet them. Do not depend on any one resource. Keep talking as long as you have not accepted an offer. You need to explore as many options as you can. Use your network for introductions. And then you have a short email with the 1-pager, as I said, that you can send them to see if they're interested. And then as they become more interested, you can then you can ask in that email for a short meeting with them, say a 15-20 minute meeting, to give them a 5-minute pitch and along with questions, and then increase that with interest. As if you find the investor is interested, then you can start spending more time with them and going into more details. Okay. And finally, some tips. You need to know how much money you're looking for. Okay, avoid asking for too much money or too little money. Both of them have drawbacks. If you ask for too much money, the valuation is going to be inflated. It's going to be very hard to show your investors that you're going to make returns on that. On the other hand, if you ask for too little money, you won't be able to execute your plan. Okay, so a good guideline is that, again, going back to the list of investors that we talked about in the beginning, at each stage, we're basically increasing the amount of investment that we're looking for by 5 to 10 x of the previous stage. Okay, so and then as I said, the investor usually is interested in what we're doing as well. So you're looking for investors who have the relevant experience and passion. Avoid what we call dumb money. Okay, so avoid people who are just putting in money and don't understand really what you're trying to do, because then you're going to have problems, because they will be asking you for the returns at different stages that is not relevant for you. But also avoid someone who completely really understands it was what we call too smart money. And what I mean by this is who are investors who are already operating in a similar business, because because that means they're probably investing in it for strategic reasons rather than to make your business successful. Okay, and finally, always understand that your investors are the best signal to the financial health of your business. So always listen to the feedback that you can get from your investors. Okay. Okay, I'm going to stop here for a moment because I'm going to go next into the art of pitching. So I would like to see if there are any questions about the first part that I've covered. No? Okay, I will go on. Perhaps then we will keep the questions until the end. Okay, so now let's talk about the art of pitching. How do you actually pitch, and how do you put together the pitch for your startup? Okay, So first of all, be prepared. It's very important to practice, to prepare for your pitch. Don't try to wing it. Don't try to just go and try it out with the investors. You need to practice a lot at home, in front of a mirror, with your friends, with your family, etc. So that allows you to be confident in the way you're pitching the startup. And it's also important when you're pitching in a big room to project your voice, to try and make sure that you are addressing the whole audience in the room. Okay. Wear comfortable clothing. Wear something that is smart but also comfortable for you. Okay. That gives you the confidence that you need. Okay. And as with the versions of the documents, the business plan, the pitch itself can also be, there's different versions of different lengths that you can pitch in. Okay, so be always prepared to pitch. You can pitch starting from 1 minute or less up to a 5-minute event pitch with slides, and then also if you have a long meeting with an investor, limit your pitch to no more than 10 or 20 minutes maximum, because you want to allow more time for questions than the pitch itself. Okay, the questions are really where it gets interesting. Okay, so you want to give as much time for that as possible, even if you have more time. Okay, and so we're gonna talk here about how do what are the 12 critical elements that you need to include in your business pitch, and how can we use those elements depending on the length of time. Okay, at the end we're gonna see how that works. Okay. But you're going to note as we go through this that we have like little colored squares at the top of each slide to indicate the importance of those elements. Okay, and we're going to talk about that at the end. Okay, so 12 critical elements that you need to include in your business pitch. So the first one I've called it number 0 because it's not really a slide, but it's just a very simple thing that you need to introduce yourself. Okay, you introduce yourself and your company very simply. Okay, my name is Hisham. I am from InnoVentures. Okay, and you start off with that. It's very important that also you understand that you are establishing a personal relationship right from the beginning with your audience. You want to establish a connection with the audience. You want to make it feel personal. You don't want it to appear like a performance too much. Okay, so you want to introduce yourself, say hi to the audience. Depending on how big is the crowd, you can introduce yourself to each of them individually, or if it's like a big crowd, you just introduce yourself. My name is Hisham, and I'm from a company called InnoVentures or whatever. Okay, and as you can see at the top, there's these 3 traffic light colors. We're going to come to that in the end, but these indicate how important and how essential each of these items is, depending on the length of time that you have. Okay, so in this case, we have the three colors. That means this is something that you always do. Okay, and then the first thing that they actually start talking about in your presentation is grab our attention. Okay, you want to make sure that from the very beginning you say something interesting that will pull the attention of your audience and grab them and maintain that attention for the rest of the presentation. So this could be something funny or shocking. Okay, so for example, we had a company that was selling a small machine that does desalination of water, so removing salt from water. And so their grab was they put a pie chart on the screen that looked like the Earth, and it just said 98% of the water on Earth is salt water, and all he says is we live in a world of salt. Okay, so this is the grab. They start with a very interesting, shocking statement, and it's something that is related to their business. Okay, so the strongest thing is to use a number. Okay, and use a number that is related to your business to show the size of the opportunity or size of the problem that you're trying to address. Okay, the next thing is you want to give a very brief overview in 1 sentence about unique product or service. Introduce your product or service in one sentence. Okay. And so here it's, you want to think about a sentence less than 20 words that says, what is the main idea? How are you different? And what need are you filling? In very, very briefly. Okay. So you say, we are solving, we are offering a website, for example, that allows traders to interact, and this is different in this certain way for customers who are in whatever markets. Okay. And then the next slide, you can go into, if you have more time, you can go into more of the underlying magic or technology behind your product. Okay, how is it creating value? How is it unique? You can talk about that in more detail after you've given this very brief overview of the product. Okay. The next point is you talk about the markets. Describe your target market. Okay, who is your customer and what is the market? What is the market size? So how do you do this? Of course, you need to have developed a customer persona. Okay, so you create an imaginary customer character, even give them a name. What is their age, gender, location, etc.? What are their interests? What profession they're in? What is their income, etc. So I'm sure you've covered this in several other topics. But basically, you need to summarize your customer persona and present it in this part of the presentation. Okay, and then you want to say, what's the market size? So how many of those customers are there? Can they be identified or reached? We call them, are they addressable customers? And then once you identified that number of customers, if you multiply that number of customers by the annual revenue you can get per customer, that gives you the market size. Okay. And you need to also think about how fast this market will grow yearly. Okay. One way to do this market size exercise is to start with, the total population of the market that you are addressing, and then break it down by the characteristics of the persona that you have identified. Okay, so you can start, for example, if the total population of the country is 90 million, the women are about half, so 45 million. The ones aged from 16 to 30 can estimate them about 25 million, and then the working class, based on the income level, is about 12 million. Okay, so I get a number by going top down, making this guesstimate if I don't have the data. If I can get the data, of course, that's even better. Okay, and then I take that number, go back and plug it into this equation. I multiply that number of customers by the annual revenue, and that gives me the market size in dollars or pounds or whatever it is, or dirhams or whatever it is, the currency. Okay. All right. The next slide, you want to show the revenue model. Okay. How does your company make money? Okay. What is the revenue model? And to think about this, there are 7 types of revenue models. There are, either you're selling a product, you're selling a service, you're charging a subscription, a subscription on a monthly or yearly basis or whatever. You have a transaction fee. That's another type of revenue model. You're licensing, your software or your technology or whatever, the asset that you are offering. You can be getting revenue from advertising, or you can be getting revenue by trading assets. Okay, so I'm buying an asset at one price and selling it at a higher price, and that's how I make money. Okay, so these are the 7 types of revenue model, very simply. And once you've identified the revenue model, you want to put together some kind of diagram that shows the revenue model. So something like this. So this is the example of, for example, Kickstarter. And this is the kind of, the description of the revenue model. It shows how Kickstarter is charging these micropayments to community backers, and then pays some of that funding to the funding seeker, but they take, the 5% commission. And then the funding seeker then provides exclusive products or service to the community backer. So this is a very brief description of, the revenue model. You want to have something like this. You want to have on this slide showing the revenue model, a very simple diagram showing how it works like this. Okay, the next part is the competition. So you need to think about who are your competitors, who are you competing with, and what is your competitive advantage? How are you better than those competitors? And how do you have barriers to entry? How do you have things to stop other competitors from competing with you in this market? Okay, how can you? It could be you have intellectual property, you have a technology of some sort, or you have some kind of license to operate in a certain industry field or whatever. So you want to show how you have this advantage, okay, at your competitors. And then you want to talk about your strategy. This is the seventh slide. How will you reach customers and how will you compete? You can talk in more detail about your strategy. Am I going to make partnerships with certain people? Am I going to be positioning myself in a certain place or with a certain brand, etc. Okay. So now we've finished everything about the business itself. We go into some practical aspects. Okay. So talking about your team. Okay. So what are the roles and backgrounds of each member of the team? What is the role of each person, and why is that person one of the best people that are able to allow you to succeed in this business that you're offering? And the best way to do this slide is to have just pictures of the 3 or 4 key people, the founders and the key team members leading the startup, and then the name underneath each person with the title. And then as you talk, you can describe the background and why they have the edge in this part that they're working in. Then you go to your action plan. What progress have you already made, and how is it, and what is the timeline? And here's an example of how we can show the timeline, the action plan in the form of a timeline. So basically, you show them an action plan for about 2 years ahead, 2 to 3 years perhaps, and show where you are now and what you're planning to do along this timeline in terms of actions and also in terms of your sales targets, basically. Okay. And then the next thing is, what are your revenue projections? Okay, and your financials. And here it's very simple. You just show a table showing the revenues and costs and profits. Okay, so that's just a very simple table, or you can do it in the form of a graph with one line showing the revenues, one line showing the costs, and one line showing the profits. Okay, and here you don't need to describe the whole thing. You don't need to talk through or explain each of the numbers. Just give very brief highlights. Like, for example, when you break even, we're planning to break even in 18 months, for example. Or what are your returns? We're expecting to make, a 20% ROI or whatever it is. Okay. Finally, the very last slide is make an ask. So you've described, your business and your team and your plan very well, etc. You now make an ask. You make an offer, or you want to show how much money you're looking for and what are you going to use it for. Okay. So this is just the final slide. Explain your funding needs. Or if you're pitching to someone who is not an investor, you're asking actually for something else, then you want to talk about, we need support in this part, or you need someone to help the team in something in particular. Okay. So in summary, as I said, we have these colors. So as you can see, there were 8 points out of the 12 that I mentioned that have the red square. 10 points have the yellow square, and 12 points that have the green square. Okay. So depending on the time you have, you're going to cover either between 8 to 12 of the points that I have already described. And this is a very simple tool that we have developed that summarizes this all, and we can share. I can share this with you through the event organizers as well, if you like. It's a simple tool summarizing the 12 points that we need to address as in our pitch. Okay, and as you can see, it's labeled by the importance. So again, this is a way to allow you to plan, depending on the amount of time, what elements of the pitch that you would include. Okay. And it's broken down into 3. Basically, your pitch is in three stages, which are related to the 3 lines on this planner. So the first stage is basically the introduction, so introducing yourself and the grab and the product, service, and value, etc. The second line is all about the business part, the market, the revenue model, competition, and strategy. And then the last line is about the the practical aspects, like the team, the action plan and progress, the projections, and how much money you're looking for. Okay. So it's like a play, or like any kind of composition. It has three parts, three acts. Okay, the introduction, the main climax, and then the final resolution. Okay, some final tips. Start strong. Always think about how you can have something really strong in the beginning, as I said, like a grab to pull attention. If you're not able to grab the attention of your audience in the first 20 to 30 seconds, then you lose them for the rest of the presentation. Okay, so cover the essentials quickly in the beginning. Expect what the questions are. So if you know what questions people are going to ask, then you can not go into detail on those things, and have extra slides at the end and use them only when people ask questions. And then finally, there's this thing called the 10-20-30 rule, which you always want to stick to. You don't want to have more than about 10 slides in less than 20 minutes. And your font should never be smaller than 30 points. So as you can see, the 30-point font is the title on this slide. So if your slides have smaller fonts than that, then it's you have too much detail or too much text on the slide. Try to keep it visual as much as possible. Okay. Finally, remember, if you don't have revenue, you don't have a business, so you need to show how you're going to make revenue. Make sure we see what is the broken leg, as I said in the beginning. Avoid competing on price. Show us where is the real value creation that you're creating through what you're doing. Show an understanding of how and when your customer is buying. So as I said, again, the investor is coming to you because you're telling them that you are the expert in what you're doing. Okay. So you need to demonstrate that you really understand this market, and you understand who is involved and how it works. Okay. And then related to the investor, know your ticket size, know how much money you're asking for. You need to go with a number. It's very important. And then finally, again, be careful. Investors in a very similar business. If they're in a very similar business, it's okay to pitch to them, but you have to be careful, not to share intellectual property. You have to be careful. You have to try to understand from them what kind of partnership or whatever they're looking for. Are they really looking to invest only for financial return, or are they trying to partner with you or whatever? It's okay to do that, but you have to understand. Okay. And finally, it's the harder we train, the luckier we get. To be ready to take take advantage of the opportunity with an investor when it comes. It's important to practice as much as possible and to train. And that's the most important thing I would say to leave you with. It's very important to practice as much as possible and to prepare as much as possible how you're going to present and how you're going to pitch to the investors. Okay. So thank you very much. With that, I'll leave you with this message, and I'm ready for any questions.
We already have questions in the chat.
Okay. Can someone tell me the questions, because I'm not. Okay, I got them now. Okay, so someone asked, طيب في حد سأل ممكن ملخص سريع بالعربي؟ شور، خلينا ارجع كده وايه يعني هي الملخص كله يعني بيجي في الايه في السلايد دي، والسلايد دي اتس ا تول ممكن ابعتها لكم، ممكن نخلي برضو التيم بتاع الايفنت يبعتها لكم، وهي بتلخص دول ال 12 نقطه اللي احنا محتاجين ان احنا نيجي نتكلم مع انفستور ان احنا نكفر ذم كويس. فباختصار شديد بنقدم نفسنا، بنجذب انتباه المستثمر، بنقدم المنتج والخدمه بتاعتنا، يعني ايه هي النقط اللي مكتوبه في دي. ولو في تفاصيل اكتر من كده يعني ايه، لو في اي سؤال انا تحت امركم. اوكي. Okay, so someone asked about elaborating on the too smart money again. زي ما قلت انه it's related to whether the investor is actually operating in that same business. For example, if you are you have a startup related to, for example, manufacturing automobile parts, for example, yeah, okay. And if the investor already sells automobile parts, then they are already in that business and they understand it. So you want to understand why they would like to invest in your business rather than do it themselves. And if there's a good reason, that's great. There's a way to collaborate. Now maybe they're now moving to investing because they don't want to be operating. But this is the thing. You just want to avoid someone who's going to invest in you, but ultimately they are trying to compete with you, or they're trying to buy your business because they want to shut you down or something like that. So you want to be careful of that. Okay. There's the next question. If I have a good product but without a team, how would I compensate that while approaching the investment? Okay. So I said this. I mentioned this very briefly. Okay. And the team could be actually. So I mentioned it here when we were talking about solid team. Okay, can be conditional. Okay, so conditional meaning what? It means I know someone, a friend, or someone that potentially could be a member of my team in the future, and that person will join. I can include their name in the presentation, and saying that they will join, once we've raised the money, or something like that. So it can be conditional based on whether we raise the money or not. Okay. The next question: should we always follow the same structure for the pitch deck? Very good question. Okay. So this, what I put here, this series. Again, sorry for flipping quickly, but here again, this is the summary. These are the 12 points that we need to cover. And this is the best sequence in most cases, okay? But it's not, it's not set in stone. You can change the order if it really makes sense for your pitch. For example, sometimes the grab is related to the competitive advantage. So perhaps I'm going to mention the grab and then go straight into competitive advantage, for example, and then go back and talk about it. So it's not set in stone, but it's the based on most people who have talked about pitching, they have around the world, they have agreed that this is a good sequence. But if you have a good reason to change it around a little bit, as long as you're covering the same points, you can change those the sequence slightly. Okay. Okay. Finally, so there's another question. How is pitching different when the target client is a government entity? Let's say educational platforms started selling their idea to a Ministry of Education. Is it better to ask okay. So this question, if you're pitching to like an NGO or a government or some kind of nonprofit entity, what they're looking for is not really the return on investment, but they're looking for the impact that you're going to create. Okay. But it still means that you need to show that you have a successful business. You still need to show that you're going to be able to make money, because otherwise they will be skeptical about the sustainability of your business. If you can't show that your business can survive on its own and make money, then as soon as the funding that you receive from the government entity is finished, you're going to shut down, right? So you still need to show. So I think all of the first 11 points are going to be the same. You're still going to talk about all of the same things in that case. The only part where it's going to be different is the ask. And in the ask, you're going to say, well, I'm looking for this much money and I'm looking for other kinds of support, but I'm not going to be talking about, I'm not looking for it as in terms of, in terms of return on investment, but we're going to talk about the impact that we're going to create. Okay. And then all through your presentation, you need to somehow include how you're going to make impact in terms of what that government entity is looking for. Okay. Okay, the next question, it says, is it better to ask the whole amount from one investor or ask smaller amounts from several investors? I don't think it matters. It doesn't matter. If you can get it from one investor, there are pros and cons to that. One investor makes it easier to deal with that investor, but it might be that that investor then has too much control or too much influence on what you're doing. And so it might be that it's better to have several investors. So there are pros and cons. And so in the end, it doesn't really matter. As long as you trust your investor, you want to make sure that the investor is someone you would like to work with, you would like to build a partnership with, you would like to have a good relationship with. So that's a more important thing than whether it's one or more than one person. But ultimately, you're going to be taking your investing in stages anyway. So perhaps your first investment is put in, say, $20,000-$30,000, something like that, and then your second investor is going to be putting in closer to, say, $100,000 or more. So you're going to be raising in stages anyway. You don't want to raise all of the money up front, because that's going to actually force you to give up too much equity. You want to, as I said here, when I showed the stages again. So this is what typically at the end of several rounds of investment it looks like. So each of those went in at a different stage with a different valuation. And so in that way, even if in each stage I have one investor, I still in the end have several investors or several people holding shares in the company. So that kind of counteracts that point. Okay. I think that was the last question in the chat. Was there anything else? Okay. I think I've addressed all the questions that came in. So Abdelhadi.
Yes, thank you, Hisham, for your beneficial talk. It's very interesting, and thank you for participants for their questions. It's great. So thank you so much, and
thank you very much.
See you again.
Thank you, everyone. Thank you, Abdelhadi, for the opportunity to be part of this, and thank you all for listening to me. And I hope it was useful. And the best of luck, inshallah.